Hello and welcome to Moneylife News and Views. I'm Debashis Basu. For years, India was the emerging market that the global investors worried about not owning. Now it has become one that they seem quite comfortable doing without. In a Bank of America survey, the latest one, which is called the Asian Fund Manager Survey, India has replaced Indonesia as the least preferred Asian stock market. The survey identified the absence of opportunities in artificial intelligence as the biggest concern, followed by weak growth, high valuations, and insufficient economic reform. Newspaper editorials have amplified the alarm, urging policymakers to read the warning signs before it's too late. But the underlying reality is far less alarming than the headlines suggest. I am not pessimistic at all. For much of the past decade, the Indian investment proposition was almost self-evident. Here was the world's fastest growing large economy with a vast population, rising income, a modern banking system, a digital economy, and a government willing to spend on infrastructure. China had become difficult for geopolitical and regulatory reasons. Many other emerging markets were either too small or too dependent on commodities, and so India seemed to offer the rare combination of scale, growth, stability, relative stability. Indian equities acquired a valuation premium over most emerging markets because investors were buying the promise of tomorrow's India. The obvious question, therefore, is whether that promise has disappeared. In fact, it's quite the opposite. That promise has arguably never been brighter in the 35 years since foreign investors were first allowed into India. The catch is that much of that it is visible in a part of the market that FPIs have largely ignored, which is smaller companies. According to me, India is witnessing an extraordinary rise in entrepreneurship across sectors with powerful and potentially durable growth drivers. Pharmaceuticals, engineering, capital goods, services, defense, and power infrastructure are among the most important of these. The business and stock market performance of companies in these industries has fattened the purses of investors who were early enough to spot onto this opportunity and continuing to profit from them. Who are these people? They are investors in the domestic counterparts of FPIs, which is Indian mutual fund industry, and also the retail investors who are investing in these sectors. The numbers tell the story rather better than a fund manager survey does. In October 2024, FPI flows turned sharply negative, with an equity outflow of 94,000 crore in a single month. Between October 2024 and June 2026, more than 50 billion, or roughly 44.5 lakh crore, was withdrawn by foreign investors from Indian equities. Yet, between October 2024 and July 2026, roughly 6.3 lakh crore entered mutual funds through systematic investment plans. The contrast was particularly striking in March 2026 when FPIs sold about 1.18 lakh crore as the markets were battered by the US-Israel attack on Iran, while at the same time, when the FIIs were selling crazily, mutual funds bought about 98,000 crore. Even in July 2026, SIPs brought in 32,000 crore, almost an all-time high. Now, follow this money a little further, and the picture becomes most revealing. In July 2026, actively managed equity mutual funds received about 25,000 crore of net inflows. Of this, only 1,322 crore went into large cap funds. Small and mid cap funds alone accounted for around 14,000 crore, or about 56.5% of the total equity mutual fund inflows in July. These are precisely the companies mentioned earlier, many of which are enjoying an extraordinary boom in business and consequently in the stock prices. Another 3,500 crores went into large and mid cap funds. The rest went into flexi cap and multi cap funds, which, although not confined to smaller companies, would also deploy a portion of that money into small and mid caps. And then there is portfolio management services, or PMS, where assets under management have risen from around 24 lakh crore to 44 lakh crore. PMS portfolios are far more willing than conventional foreign portfolios to venture down the market cap spectrum. They mostly invest in small and mid caps. The conclusion is difficult to miss. Domestic investors are not merely matching the selling of FPIs, they are directing a large proportion of their incremental money towards precisely that part of the market where foreign investors are less active. Almost 70 to 80% of the incremental mutual fund investment is, in one form or the other, finding its way towards small and mid cap companies, either directly or through diversified funds that can invest in them. Now, look at another set of numbers. The distribution of foreign money is strikingly different. According to a December 2025 analysis, 76% of FPI investments were concentrated in the top 100 companies, although this had fallen from 83% in December 2022. Their exposure to companies ranked 251 to 500 had barely moved from 5% to 6%. The distinction matters a lot. Since 2023, the Nifty Small Cap 250 index has doubled and Nifty Micro Cap index has risen by 150%. Meanwhile, with 31% of the portfolios invested in financial stocks and another 8% each in software and oil and gas, FPIs have been left staring at a relatively poor to average returns. Now we know why they are sore. What about the artificial intelligence lack of opportunity in artificial intelligence? Well, I call it the no AI non-problem. The biggest reason to ignore the FPI gripe is perhaps the strangest one. India's listed stock market has little exposure to the current mania in artificial intelligence. The great investment boom of the moment is increasingly being expressed through semiconductors, computing power, networking equipment, data centers, and hyperscale cloud infrastructure. Taiwan and South Korea, among countries outside America and China, offer investors the clearest listed exposure to this bonanza. India does not. This is hardly a reason for a policymaker to lose sleep. It would be like shunning a stock market in 1999 because it did not have loss-making internet companies listed on its stock exchange, or in 2007 because it did not have financial stocks minting money from toxic subprime mortgages. We know how both these investment fashions ended. There is also another possibility which the current AI euphoria tends to obscure. If the hardware boom eventually buckles under the weight of debt-fueled manic investment, the economic value of AI will not disappear with the share prices of its current beneficiaries. The technology will remain. Someone will have to build applications, integrate the systems, and help companies use AI to raise productivity. It may turn out that the Indian software engineers, rather than semiconductor manufacturers, are among the enduring beneficiaries of the AI boom. For these and a variety of other reasons, India should ignore the Bank of America survey. It should not, however, ignore surveys of business managers. It should ignore the portfolio managers and what they're saying. India does need to listen to what the business managers are saying because we need about $100 billion of net foreign direct investment a year, much of it in manufacturing. Such investment would bring technology, build skills, create jobs, and most importantly, convert India's enormous domestic scale into internationally competitive production lines. On this front, India is not making nearly as serious an attempt as it should. Mark my words, if India does get 100 billion net investments in FDI, it will create companies which the FPIs would then want desperately to invest in. Thanks for watching, and if you did like this, please do share and subscribe.